Have a guest. And let me tell you something, everyone. The Dayton deal, we were going to do a loan assumption, right? We were going to do a loan assumption on this Dayton deal.
Come on, bud.
It took 6 months. 6 months. And we didn't even, the lender couldn't even tell us when we were going to close. And this was in December.
Which lender?
This was, who was that lender?
No, it was the assumption, loan assumption.
Yeah, the loan assumption. Yeah, who was that? I don't remember the name of them, but man, let me tell you something. 6 months. So this is what happened. The seller said to me in December, no, it was before December, it was on our 6th month, and said, what's your backup plan? And I said, we're going to go agency. He said, okay. I said, well, and I said, but before we do that, let's check and see what the yield maintenance is. So initially, when we got the property under contract, the yield maintenance was a little over $200,000. But 6 months later, the yield maintenance had dropped so low, it was like less than $60,000. So we said, yeah, we're going to go ahead and move forward and we're going to get agency. So
can you explain what that means, Darryl? The yield maintenance?
Say again.
Can you explain
Sure. The yield maintenance is a penalty that you will have to pay when you're doing in the event that you sell before the term is up. So
like a prepay.
Let's say you got a 5-year term and you sell, say, year 2 or year 3, is going to be a penalty on that. You're going to have to pay. And with the yield maintenance goes according to the market. So that's why it dropped from 200,000 all the way down to less than 60,000, because the interest rates has started going up, inflation started creeping in, yield maintenance came down. So, and that's what put us in a position to where we were able to get agency debt. And at that time, I was talking with, I had met this young lady. She was really cool. And the one thing that I needed was education. And I reached out, we had already been in communication. And when I met her, I said, you know, of course, you're going to have to educate me. I said, I want to be educated and walk through this whole process. Met her and her team, and I'm going to tell you something. They educated me, walked me through the process, literally held my hand just to make sure everything was cool. And we closed in less than 45 days. Less than 45 days. Her name is Natalie Dumont. Natalie, please introduce yourself, tell everybody who you are, where you're from, and take it away.
All right. Hi, everyone. Hi, guys. Very nice meeting you. By the way, Darryl, I wanted to say that your lender was ReadyCap. Alicia, that was your
That's
question.
who it was? ReadyCap?
ReadyCap. Yes, yes. And interesting, you were talking about the yield maintenance. It's exactly what happened. So basically, rates started going up significantly around June. And that's how you probably ended up, the seller ended up with a much lower prepayment penalty that they had to pay by the time you decided to go for a new loan. It was, I think it was around like $10,000 versus $200,000. It's unbelievable. I personally have never seen that before. So, because yield maintenance is known for being the steepest prepayment penalty, you know, but that's exactly what happens when the market deteriorates, because it goes along with the market, with the current market. And for those who are not familiar with yield maintenance, the way it works, basically, if you sell or refinance the property before the fixed period expires, you guys have to pay a prepayment, like for all the years left on the fixed rate period worth of prepayment penalty. That's why it's the steepest. But again, it's a great prepayment penalty depending on the strategy that you have. For some people, it's really great. Anyway, so let me introduce myself. So my name is Natalie Dumont. I have been in real estate lending almost 20 years. I started with in residential lending up until 2009, and then I moved to commercial side of things. So I was a broker for a little bit, which I realized that it was too soon for me to be a broker. So I moved to work for a commercial bank based in California. Again, multifamily lending. And then after this bank, I decided that the agency world was much better fit for my market and where I wanted to be. So I started working for a company called Sabal Capital Partners and spent a couple of years there, and eventually moved to CPC, which is my current employer. CPC stands for the Community Preservation Corporation. We're the only nonprofit agency lender on the market with a 50-year history of lending on multifamily. So we started as an affordable lender and a construction lender, and we still, we made a big name for ourselves in that space. But eventually, when the agency programs opened up in 2015, we got the licenses for small balance, large balance, and we've been growing these platforms the last few years. And that's how I met Darryl. Somebody referred me to Darryl, and I was so excited to meet him. And that's how we actually got our first deal together, which we were very happy to work with Darryl because he was really our perfect client for us. And I'll tell you what makes a perfect client. So basically someone who is fully engaged in the process, someone who has a very strong sense of urgency, because technically you get 30 days to get all the due diligence items from the seller, from the third parties. And Darryl was responding within, seriously, sometimes minutes to our emails. And that's what underwriters really appreciate. And that's when they actually start being very sensitive to clients, and they fight on your behalf with agencies. So I've seen it many times. Unfortunately, not every client is the same, but I'm just telling you, this is what made it such a great transaction. Are you guys familiar with agencies, with agency programs? So do you want me to go over agency lending on a high level? Darryl, what do you think?
Yeah, let's discuss that, because you do have a lot of new people here, you know. Matter of fact, for everyone, hold on one second, everyone. Everyone that's new, put a 1, hold on, man, not chat, right now. Okay, put a 1 in the chat if you're new. Look at that, dude. Oh, yep.
New
oh
to
man, somebody got 10.
Or new to the group?
New and investing. Okay, yeah, and new to the group. Yeah, let's hit it all the way around. All right, because look at it, you got a bunch of 1s. So Natalie, yeah, let's break it down for them.
Okay, fantastic. So I'll try to keep it relatively short, you know, so you have time for your deal. So first of all, you guys as investors face overwhelming variety of lender choices these days. But rather than focusing solely on rate, loan amount, closing costs, which I know is very important to you, when you're comparing lending alternative, it's very important to understand how a given loan will affect your long and short-term investment strategies. So there are a number of factors that are crucial in determining whether a financing solution will enable you to make your investment goals. For example, it can be recourse or non-recourse, operational flexibility, post-closing, servicing. So all those factors are very important. So Fannie Mae and Freddie Mac, also known as agencies or GSEs, government-sponsored enterprise, are two of the most competitive lending sources around, backed by a government-imposed duty to supply liquidity and stability to the multifamily market. So agencies are a proven, reliable source of capital during recession, the pandemic, and other volatile market conditions. So agencies provide consistent access to capital, regardless of location or exposure or market conditions. And today, the market share for agencies is probably somewhere between 50 and 60%. So think about it, 50 or 60% of the multifamily properties in the country are financed by Fannie Mae and Freddie Mac. Agencies do not lend directly. They have approved private lenders who make loans to borrowers like you and sell them to agencies. So Fannie and Freddie then pool a variety of other loans together, that is called securitization, and sell to bond investors on secondary market. So why are agency loans so popular? What are the benefits and how do they compare to banks? First of all, programs are designed to compete with banks. So you get a prime rate, basically very, very similar to what banks offer you. And often we even beat the banks depending on the term you're looking for. Agency loans are non-recourse and assumable. Again, we just talked about assumable. Nearly all banks will require recourse up to certain LTV, where agencies are completely non-recourse. Assumption, again, is a popular option these days. Unfortunately, it takes time, like Darryl mentioned, but for some situations, assumption is really a great option. We give you higher leverage. So in most markets, we can go to 80% loan to value on acquisitions and cash outs, where again, banks are a little more conservative, typically up to 75%. I do work with other banks who refer loans to us that are capped these days at 70%, for example. We offer longer terms. So in addition to 5-year, which is the most popular term with the bank, we have 5, 7, 10, 12, 15 years, and even 30 years. And I'm not saying that 15 and 30 years are the most popular options. They're actually the least popular option. But for some borrowers who, for example, smaller investors who buy properties that they want to keep forever in their family, 30-year loan might work. You get a choice of hybrid or fixed loans, a longer interest-only periods, again, something that you may not be able to get with the bank. We have flexible prepayment options, especially these days. For example, reduced prepayment option is very, very popular. Agencies understand you don't want to lock yourself into a long-term loan at a high rate. So they basically make some adjustments, pricing adjustments for you to be able to get the reduced prepayment option. Our amortization is 30 years across the board, which is great because, again, at the bank, you will most likely get 25%. There is no deposit relationships required, which I know for a lot of people is a big deal. So if you had your money with whatever your favorite bank for a long time, and you all of a sudden have to transfer all the assets to another lender, that's not ideal. No such thing with us. Very important that we have no such thing as an investor concentration, also called overexposure. So where the bank may limit you to whatever 3, 5, 15 loans, you can get 50 loans with Fannie and Freddie, and they're actually happy to give you that many. The more you come back, the better off you will be, because agencies really like to see repeat clients. And in terms of third-party reports, some banks require additional, like environmental reports, which we may not require, but most importantly, we do not ask for tax returns, which is always a requirement for the bank as far as I know. And another very important thing about agency programs is that they're nationwide. So basically, when buying outside of your home state, where you may know a lot of local banks, where do you go when you buy outside of your state? So agencies is always the first thing that investors usually look at. And if the loan does not fit agency, typically they start looking at other lenders. Who qualifies for an agency loan? It takes some work to qualify for sure, but it's not as difficult as, for example, HUD FHA loan that has strict requirements, experience requirements with HUD. First of all, agencies do care about multifamily ownership and management experience a lot. So they position themselves as lenders who are looking for experienced operators. I can tell you guys, it doesn't necessarily mean that they cannot work with a new investor. And I will explain it to you. I will tell you how it can be done. So there are requirements for net worth, which has to be at least equal to the loan amount you're requesting. And liquidity requirements, post-closing liquidity requirements, you have to have at least 9 months of principal and interest payments. So these are just basic requirements. 680 FICO, property has to be stabilized. And for those of you who are not familiar with the definition of stabilization with agencies, just remember the rule 90/90. That means that the property has to have been occupied at least 90% over the last 90 days. So basically, you can come to me when the property has been occupied for 30 days, and while we're in process for 60 days, we will reach 90, but it has to be 90/90. There is such thing as an exception between the two programs, which is small balance and large balance. And small balance is something that is between $1.2 million and $7.5 million. Anything over is a large balance program that is also called DUS program. So there's a slight difference between these two, depending on which program your loan is going through. We may sometimes ask for an exception, T1 exception. So basically 30-day occupancy in place. That happens. Again, this is why you need a lender or very experienced broker, who is familiar with these things, and they go along with all the changes and adjustments that agencies do practically every day. So a typical agency client basically is a multifamily investor who has owned at least one multifamily property, 5+ units for 5 years. If you do not have 5 years, agencies ideally are looking for 2-3, a couple properties owned for 2-3 years. If you don't have that, then this is when we start working in your file, packaging it, go into the agencies, asking for the exception for the lack of experience, which in my experience, I never had that request denied, but it requires some work. So, and certainly there should be some compensating factors present. Maybe you have a little bit more in the net worth, that agencies will be comfortable with. The other things, that basically give them some comfort. So the most popular types of agency loans that you guys will probably be looking at or already looking at, Fannie Mae small loan up to $6 million. Again, minimum is 1.2. Freddie Mac small balance loans, pretty much the same program, but there are some nuances that the lender will tell you what is the best execution for your loan. Fannie Mae, Freddie Mac conventional, which like I said, is called also DUS program. Supplemental loans, like for example, if you do an assumption and you have to bring a lot of money as a down payment, maybe you should look into an opportunity to get a supplemental loan. Just remember that supplemental loan can only be issued by the lender who holds the senior debt. So for example, Darryl, if you wanted to do an assumption with ReadyCap and you needed a supplemental, you would only have to go to ReadyCap for that. Just keep that in mind. Also affordable housing programs, so a lot of affordable products. So basically between the two agencies, there are more than 50 multifamily financing products to choose from. Simple agency loan terms, again, 5+ unit multifamily, 90% occupied over the last 90 days, 1.2 million minimum, When you come to me, the first thing I look at is the market. There are 4 different tiers with Freddie Mac, a few different tiers with Fannie, and I can tell you that those markets are categorized very differently with 2 agencies. To give you an example, Houston, which is Harris County, for example, is a free review market with Fannie Mae, meaning they can only lend up to 65% LTV. They're at 135 debt coverage because Fannie sees this market as a cooling market. While for Freddie Mac, it's a standard market. You're at 125 debt cover and 80% LTV, completely different terms. So these are the things that I can tell you when you come to me. Again, most popular options are floating or fixed rate options, 30-year amortization, partial or full term interest only. Yes, you can get a full term 10-year, for example, 10-year full term interest only if you are under 65% LTV, which is pretty amazing. You get this choice of prepayments, yield maintenance, step down that you usually see from the bank, week and week plus prepays. These 2 are very popular for loans that with the whole period of 5 years. Again, non-recourse and assumable. And the last thing I wanted to mention, guys, is why is it important for you to build relationships with a multifamily lender? I see a lot of investors make common mistakes. For example, the biggest mistake is to underestimate the legwork you have to do before you apply for agency financing. There's a lot of work that needs to be done to make sure your transaction will be smooth. Again, we look at the sponsor team, how strong they are, where is their net worth, where is the liquidity, what is the experience? Because the property might be great, the cash flow might be great, but the last thing, investor experience, doesn't exist. So guess what? It may easily kill the loan, or it means that we need a lot more time to take care of that, to negotiate with agencies. We look at the T12 concessions, delinquencies. We look at expenses. How can we reduce expenses? Not necessarily, reduce proceeds, because there's a lot of concessions. All these things that we consider, and I will educate you so you know next time when you underwrite what to look for. I see investors assuming wrong terms. I often see that they think they can get maximum leverage based on their underwriting. And we know lender underwriting is very different, not very different, slightly different, I should say. Investors account for longer interest-only periods, which may not be available for this particular transaction. In different terms, different options in the loan that maybe you are not even thinking about, but I will tell you it's available for that loan. So basically build relationships with the lender, find someone who you're comfortable working with, or it can be a broker, because the brokers are super instrumental at bringing you multiple quotes. Just remember, agency, go to one agency, do not go to many. Fannie and Freddie get very upset when they see borrowers shopping around, because we all get the same terms, we all get the same rates. It all comes down to how strong your this company's relationships with Fannie, Freddie. How do they price the loans? So basically, companies with a huge overhead will certainly have a larger margin priced in. So these things, but in terms of getting multiple quotes from the banks, from private lenders, from agency lenders, again, brokers might be very instrumental. Just find the person who is responsive, someone who, how are they in terms of sharing knowledge? Do they provide real consultation to you? Or is it just a quote? Because unfortunately, a lot of lenders on the market are transactional. Just remember, we are here to help you. We want to get to know you. We want you to see us as basically friends. You can text with any questions during your underwriting. We are your support. So that's
Fantastic.
That's what it is.
Thank you, Natalie. That was fantastic, and I could definitely vouch. They are very educational, and I went in firsthand. I just told them, just educate me, because I want to learn through the process. The same way we're going to do the acquisition summit, you're going to learn through the process, and that's how Natalie and her team even they say, hey, we're all getting together with you. so that we can ask you questions, you can ask us questions, and really they can educate. So, and they did. They met with me, and we ran through everything, taught me a lot of stuff. So, but now that was there's a few questions. Jermaine asked, any loan covenants?
What exactly do you mean by that?
All right, Jermaine. Phoenix CPA.
Is this the non-recourse question? That's what he means?
Well, typically, some bank loans have covenants for revenue covenants or minimum rent covenants, but also other financial ratio covenants that you have to keep outside of the building that you own. Personal leverage amounts of personal loan restrictions for total LTVs, ratios, things like that.
So basically, I think, I hope I understand the question correctly. So basically, when you get the loan from an agency lender and you submit your financials, it's different for, usually it's quarterly financials, but some people submit it annually. I've seen that happen. You have to be at a minimum debt coverage for sure. I think it's 1.0. Honestly, I'm not in servicing, that's why I don't know exactly, but I think it's 1.0. That's where you have to be. And your occupancy still has to stay over 90%. So if you go below these numbers per your financials that you send to the servicer, and they see that, they will get a little bit concerned. But if you keep paying for the loan, they will still give you some time. Like, for example, you decide in 2 years that you want to upgrade units, right? And your occupancy drops temporarily. So that's totally fine, as long as you explain it to your service. It's very important for you guys to work with the servicer so they do not make, so they make the proper notes and they don't put you on the watch list. Jermaine, did I answer your question or not?
Yeah, I think so. Do they, once you get the loan, is this done annually, or are they constantly checking occupancy, or once it's done, it's done? That's more.
No, they definitely look at occupancy because you have to submit financials. Like I said, some people do it annually. If there is a concern, like for example, if you send financials in January and there is lower occupancy and debt coverage, they will probably ask you to submit financials in the next quarter as well, just to make sure it's going okay.
Thank you.
Mm-hmm.
All right. Let me see. Brian asked a question. He said, Natalie mentioned Houston properties require 1.35 DSCR at 65% LTV. Oh, that really was a question. Is this also true for DFW? Why are the requirements so steep for Houston property in general?
So this is Harris County. I do not remember what county is Dallas. I can certainly check that. I'm hoping not, but I am only talking about Fannie Mae. Just remember, and this is a recent update to their market tiers. So Harris County used to be in a nationwide market category, which is 125 that cover 80% LTV, and they have downgraded it to pre-review. Again, pre-review is only for loans in tier 3. There are 3 tiers with Fannie Mae. Tier 2, when it's a full loan, 125, 80%. Tier 3, which is 65 LTV and 135 debt cover, where Harris County falls into. And Tier 4 are the loans with very low leverage, very strong cash flow. I think it's 155, under 55 LTV. So obviously these loans get better pricing, but at the same time, you have to be below certain LTV. And Harris County, yes. For Freddie Mac, it's a great market, standard market. You're at 125 debt cover, 80% LTV.
All right. Celeste, she asked, do you finance mobile home parks, stabilized and value add?
We finance mobile home parks for sure. Very popular asset type. Agencies do not do value add. I can tell you there's one program called value add actually for conventional loans, but it was put on a back shelf during pandemic and we're still waiting for it to come back. It was a great program, but they're super, super careful right now with that. Same for the lease up program, which not many people know that agencies have a lease up program, but they do. And they actually have tightened the requirements for that program recently, which we were not happy to see. So I would think of agencies as just the perm loans for now. It's very, very hard to get a value add loan unless you are an investor with owning, I don't know, 200 million, 300 million in assets. Extremely difficult.
Fantastic. Natalie, would you put your contact information
Yeah.
in the chat
Mhm.
so that everyone can get in contact with you if they need to?
Sure.
And I have a question for you. You had mentioned about the different tiers and that covers different markets by Fannie Mae. Is this open to the public where we can see what these tiers are?
No,
No?
it's a great question, Darryl. No, it's not. And this is an internal document that they only share with us. We can't share
Okay.
it. But you
Okay.
can
Are
reach
you
out to
able
me
to repeat
anytime,
those
my
things?
friend, you can text me, just text me the zip code, I'll tell you.
Cool. Okay. Moses, go ahead, Moses.
Hey Dal, good.
Hey.
I had a mortgage broker background, and I'm a New Yorker, so I don't let anything slide me. When you brought this Dayton deal, if you remember back a year plus ago, I had to ask you if you had someone that was really proficient in doing the assignment, because I've been through that ringer quite often. And one of the reason I had to ask you the question, did you check to see if the prepay had fallen down or came down significantly, was because when that happened, and this is, I guess, for the education piece of it, the seller, in your case, it was a broker who understood the market and understood the industry. But generally, the seller will lose the motivation to continue the process when they see that their prepay have significantly declined on their end, because that's more money in their pocket. What incentive would there have been for them to stay the course so you can benefit from their low interest rate? That's typically why when the prepay dies down because of higher interest rate at that time of the market, and it's yield spread maintenance, you got to really fight to stay in the deal or go look for your own financing. In your case, you had a 90/90, and I had told you your property checked out really well from my research, so you had a good product to be able to go quickly to get a Fannie, an agency debt on it. But not always. Typically, if it was something that really needed deep value add to it, then what would have happened? The seller could have said, "Okay, Darryl, if you want to stay in this game, you eat that 60,000 now, and I'll wait for you to close." That's what typically would have happened. But because you had a good property, you could have jumped to Natalie and say, "Hey, I got a 90/90. I want to get this thing closed up." And that was, but that for the regular LP, I typically state to them and say, look, if my agency debt is willing to take on this property, that should tell you this is a property that's already passed so many tests, not just my underwriting, but also an agency debt. It's much more difficult to get. But I did like your question, because that's a question that I typically go and ask my broker, is my property in a tier 3? Because if it is in a tier 3, I need to come up with a lot more cash to close, and that lowers my numbers. It lowers my return, because the more you put in, the less you return. So that's a good question that you ask her. Always go to your lender, create that rapport where you can find out upfront is what type of financing you get, because it's all the same. I use broker myself. I've always used a broker, never use a direct lender, because the broker has the power rate that's better than any other guy or gal out there. But thanks for bringing her on. She did pretty well.
All right. All right. Natalie did pretty well.
Thank you.
Let me tell you, and I was just, when I met Natalie, I was impressed. So I was like, yeah, this is really fantastic, working with her and everything. I would say you know, if anyone have questions, please reach out to her because she's definitely there. She'll answer your questions. You know, she's not, believe me, her and her team, they're not slow to respond. They respond quickly, and so forth. Is there anyone else that have any other questions? Anyone else? If y'all can stick around, 'cause I'm about to show the deal. Natalie, if you can stick around, because I didn't send this one to you yet. All right, I didn't send this one to you yet, and so this way you'll get a chance to see it firsthand. And yes, I do send my deals to Natalie because she's part of my team. All right, she's part of my team now. I'm
Thanks,
not
Darryl.
going anywhere. Yeah. All right. Any other questions before we jump into this?